Every other Friday, a massive psychological experiment takes place across the country. Your paycheck lands, and for about 24 hours, you feel like a responsible adult. You feel okay. Then the rent clears, the car payment clears, the credit card minimums clear, and by Tuesday morning, you're refreshing your banking app, staring at a balance that looks like a typo, and wondering where the hell it all went. Meanwhile, someone who sits 3 desks down from you, making the exact same salary, is quietly turning that exact same paycheck into a small fortune. And you cannot, for the life of you, figure out what secret they know that you don't. Here's the part that is going to either deeply annoy you or deeply set you free. They don't know a secret. They aren't trading options in the bathroom during lunch. They aren't picking the next hot AI startup. And they certainly aren't listening to some 22-year-old guru on TikTok screaming about leverage. The bar to get ahead of almost everyone in this country financially is sitting flat on the floor. It doesn't require a finance degree, it doesn't require an inheritance, and it doesn't require a genius IQ. In fact, being too smart is often the exact thing that gets you broke. It all comes down to 7 of the most boring, unglamorous, mind-numbing decisions a human being can make. Habits so simple that your brain will try to reject them because they don't feel dramatic enough to be true. My name is Nick, and I spend way too much time studying why perfectly intelligent people light their savings on fire, while a quiet group of ordinary people gets obscenely wealthy without ever breaking a sweat. Give me about 30 minutes, and you'll walk away with all 7 habits, putting you squarely ahead of the 95% of investors who spend their entire lives running in place on a treadmill they paid extra to upgrade. But before we look at the habits, I owe you some honesty before I owe you any motivation. Because when I say ahead of 95% of investors, that phrase is doing some heavy lifting, and we need to look at the scoreboard of the country you are actually competing with. If you look at social media, you'd assume that every 20-something has a 6-figure brokerage account and a pristine kitchen island the size of a twin bed. The data says otherwise. The reality is bleak. Survey after survey shows that nearly 40% of Americans cannot cover a sudden $500 expense with cash. Think about that. A single car repair, a vet bill, a broken water heater, and nearly half the country has to reach for a credit card or borrow money from a relative. When you strip out home equity and look at people under 40, the median net worth hovers somewhere around the cost of a decent vacation. A massive chunk of the population treats their checking account like a finish line instead of a starting line. Money comes in, money goes right back out to finance a lifestyle designed to impress people they don't even like, and absolutely nothing gets left behind to grow. So, if the bar is that low, why does building wealth feel like climbing a glass mountain in socks? It's because of a phenomenon I call the genius tax. It is the heavy price you pay for trying to outsmart the market instead of outlasting it. To see this tax in action, I want you to meet 2 characters. We'll call the first one Steve. Steve is sharp. He reads the financial news every morning, joins Discord group chats with diamond emojis, checks his portfolio at red lights, and makes 40 trades a quarter. Steve feels like an elite investor. He feels busy. Now, meet Brenda. Brenda works the same job as Steve, gets the same paycheck, and has the exact same Tuesday afternoon to spare. But one boring Sunday afternoon 3 years ago, Brenda set up 7 specific habits, closed her banking portal, and basically forgot she owned an investing account. 10 years from now, the financial gap between Steve and Brenda is going to look like they weren't even operating in the same economy. Steve is going to pay the genius tax with his life savings, while Brenda quietly walks away with options instead of obligations. Let's break down the exact 7 boring habits Brenda used, so you can copy them before you go to bed tonight. Habit number 1. The automated shovel. Most people build their entire financial life around a massive logical flaw. They get paid, pay the landlord, pay the electric company, buy groceries, go out for dinner, and then promise to save whatever is left over. Do you know what is left over? Nothing. Zero. Because human behavior follows a predictable law, your spending will always expand to swallow your available income. If there is money sitting in your checking account, your brain classifies it as available for fun, and a few days later, it's gone. Brenda does the exact opposite. She uses the automated shovel. The day her paycheck lands, 20% of it is automatically yanked out of her account and funneled into her investments before she ever has a chance to see it, touch it, or romanticize how she could spend it. Now, I can already hear the objection because I get this comment on every single video. That's easy for you to say, Nick. I'm barely covering rent. I genuinely do not have 20% to spare. And for some of you right now, that is completely true. But here is the reframe that changes the game. The goal isn't 20% on day one. The goal is to build the reflex. If you can only spare $25 a month right now, you automate that $25 before next Friday. Then you implement the second half of the habit, the lifestyle ceiling. Every time you get a raise, every time you get a bonus, every time a tax refund lands, you funnel 100% of that new money straight into the automated shovel. Most people get a 5% raise and immediately upgrade their apartment or finance a nicer car. 6 months later, they feel exactly as broke as they did before, they just have more expensive problems. They didn't escape the rat race, they just bought the rat a shinier wheel. Which brings us to habit number 2, the free money reflex. This one is painful because year after year, the data shows that Americans leave billions of dollars sitting on the table out of pure procrastination. If your employer offers a 401k match, that is your company looking you in the eye and saying, if you put $1 into your retirement bucket, we will put $1 of our own in there with it. That is an instant, guaranteed 100% return on your money. And yet, roughly 1 in 4 workers who are eligible for a match simply choose not to take it. They walk past a crisp $100 bill taped to the sidewalk every single payday because filling out the online HR portal feels like too much paperwork. Steve didn't set his up because the options looked confusing, and he promised himself he'd research it this weekend. Brenda spent 11 minutes during her first week, grabbed every single cent of the match, and let a robot handle the rest. One of them accepted a massive corporate raise, the other one refused it. Habit number 3, burying individual stocks to buy the haystack. This is where Steve pays his biggest genius tax. Steve wants to find the needles. He spends hours analyzing individual tickers, tracking stock charts, trying to figure out which tech company is going to the moon next. But a few years ago, a finance professor named Hendrik Bessenbinder decided to look at the hard math. He found that 4 out of every 7 stocks over their lifetime returned less than a basic, boring 1-month government treasury bill. The vast majority of individual stocks are actually duds. So, where does the market's legendary wealth come from? It comes from a freakishly small minority. Just 4% of the companies in the market accounted for all the net wealth generated over that entire century. The other 96% simply matched the return of cash. Stock picking isn't about being smart, it's a game where you are actively trying to find a 4% needle in a massive haystack. Brenda doesn't look for the needles. She has the beautiful humility to admit she doesn't know which 4% will win. So, she buys the entire haystack. She purchases a total market index fund. She owns the winners, she owns the losers, and she automatically owns the massive tech giants of the next decade before anyone even knows their names. And the best part? She pays almost nothing for the privilege. A basic index fund costs about 0.03% a year. Steve's actively managed funds or trading commissions quietly skim 1% or more off his balance. A 1% fee sounds tiny, but over a 30-year career, that silent roommate strolls out the door with roughly 25% of your entire life savings. Habit number 4, deleting the app, or what I call ignorance by design. We live in a world engineered to separate you from your peace of mind and your money. Modern brokerage apps are designed like casinos. Steve checks his portfolio 11 times a day. Every time he looks and sees a sea of red, a low hum of anxiety activates in his stomach. Your stomach is the single worst financial advisor on planet Earth. It treats the stock market like a Ouija board. Brenda understands that her portfolio is like a tree. If you dig it up every morning to check the roots, you're going to kill the damn tree. So, once her automatic transfers are set up, she deletes the app from her phone. She checks her balance exactly once a year, usually on a random Sunday in January while she's doing her taxes. The rest of the time, she lets neglect be her financial superpower. There is a legendary story in finance that the best performing accounts belong to people who had died or forgotten they existed. Habit number 5, building the iron wall. This habit has absolutely nothing to do with the stock market, but it is the single reason Brenda's portfolio survives when Steve self-destructs. Brenda keeps 3 to 6 months of living expenses in a boring, high-yield savings account. Steve treats an emergency fund like wasted potential. Why keep cash sitting there getting eaten by inflation when I could invest it and earn 10%, he asks. Here's why, because market crashes have impeccable comedic timing. They love to show up in the exact same season as a corporate layoff or a sudden medical emergency. 2 years from now, when the market takes a standard 20% dip, Steve is going to lose his job. And because he has no cash cushion, he will be forced to log into his brokerage account and sell his stocks at a massive 20% loss just to pay his rent. Brenda's emergency fund isn't a wealth building product, it's armor. When the crash hits and she faces an unexpected bill, she doesn't touch her investments. She pulls from her boring cash cushion. Habit number 6, killing toxic debt with extreme prejudice. Before you go wild investing for a 10% market return, you have to look at the holes in the bottom of your boat. The average credit card interest rate right now is sitting north of 20%. If you are carrying a balance on a credit card while simultaneously trying to buy index funds to earn a historical 10% average, you are setting fire to your money. Paying off a credit card charging you 22% interest is mathematically identical to finding a guaranteed, tax-free, zero-risk 22% investment return. Steve carries a rotating balance because he wanted to keep his cash in the market. Brenda looked at the arithmetic, stopped investing anything beyond her employer match for 4 months, pointed every spare dollar at her credit card until it was dead, and permanently plugged the leak. Which brings us finally to habit number 7, the crash protocol. At some point over the next decade, you are going to open a news website and see screaming red headlines about a historic financial collapse. When that happens, Steve's stomach takes over. He watches his account bleed 10%, then 20%, then 30%. Panic sets in. He sells everything, shifts to cash, and promises himself he will buy back in once the dust settles. Do you know when things calm down? About 4 weeks after the market has already surged 30% back to a new all-time high. A massive study by JP Morgan looked at a 20-year stretch. If an investor panicked and missed just the 10 best single trading days over that entire 20-year period, their final return was cut completely in half. And here is the cruel joke. 7 of the 10 best market days happened within 2 weeks of the 10 worst market days. Brenda's crash protocol is ironclad. When the market drops 30%, she changes absolutely nothing. Her automatic shovels keep clearing on the 1st and the 15th. And because stock prices are depressed, her fixed monthly investment quietly buys twice as many shares at a massive discount. Look at the scoreboard after 10 years. Steve spent a decade feeling intelligent. He spent hundreds of hours reading charts, paid thousands in hidden fees, panicked twice, and fumbled a massive portion of his returns onto the floor. Brenda spent a single Sunday setting up a self-driving machine, deleted her apps, took a lot of naps, and let compound interest do 90% of the lifting. The ladder out of financial anxiety isn't a secret code. It's a series of incredibly boring, automated decisions that remove your own willpower from the equation. Pick one boring decision from this list, the easiest one, and execute it before you go to sleep tonight. Thanks for watching. Go take a nap.